auto loan delinquencies are right at pre-pandemic levels, and this really isn't a good sign. Every quarter, Experian releases a new quarterly report breaking down the current state of the used and new car market, specifically what's going on with finances, monthly payments, and delinquency rates. And just in the last couple of days, we got the report for Q2 of 2024, which I know feels a bit delayed given the fact that we are nearing the end of Q3, but this is the way that Experian does it. And so in this video, we're going to be breaking down some of the most up-to-date information regarding vehicle financing and why some of these data points don't look good at all. Now, whenever we look at a breakdown of how many vehicles are financed and what percentage of vehicles that are financed are used versus new, used vehicles make up the majority of financed vehicles, with 58.19% of all financed vehicles being used and 41.81% being new. Now, whenever it comes to the type of financing, according to Experian, captive financing is the largest lender type for Q2, while bank and credit union shares are decreasing. And again, for those of you who aren't familiar with captive financing is basically in-house dealership financing. You can see here that captive financing grew to 30.88% of all financing, while credit unions decreased to just above 20%, quite a large decrease from Q1 where it was sitting at 23.3%, and banks have decreased from 24.67% to 24.41%. Credit unions did see a larger decrease. But whenever it comes to the sheer volume of loans that financing institutions are giving out, banks are still the winner. So whenever it comes to the number of loans, captive financing wins, but whenever it comes to the loan amounts, that's where banks comes ahead. And currently, banks make up 26.69% of the total market share for loans, while credit unions and captive financing are pretty neck and neck. This is really interesting, but not entirely surprising to see how dominant captive financing is in the new market. You can also see here that the average credit score of vehicle buyers is also going up and has been steadily going up since 2015. And on that exact same topic, whenever we look at a breakdown of what types of borrowers are getting approved for car loans, you can see here that subprime borrowers continue to decrease, while more and more prime plus borrowers are taking out more loans, which makes total sense given the fact that over the last couple of years, it is harder to get approved for a car loan, meaning that in order to get approved or for it to make financial sense, you have to have a better credit score. And you can see here that captive financing makes up more than 50% of market share for new loans. And you can see here that the vast majority of new loans are taken out by prime plus borrowers. In fact, 83% of all new loans are taken out by this type of borrower. Now, unfortunately, even though new car prices are technically trending down in the new car market, new vehicle loans are not. And while they haven't gone up by a lot, they have gone up, and that isn't a good thing. You can see here that the average new amount financed is $40,927, which is a couple $100 higher than in 2023 and a few $100 higher than in 2022. You can see here that the average new loan rate has also gone up, and the average new monthly car payment has gone up as well to $734, a mere $1 increase from this time last year, which isn't great, but it certainly could be worse. We can also take a look and see what the breakdown is of new loans based off of borrower type and how these loans have been trending year over year. And you can see here that the data is really interesting because for deep subprime borrowers, while the amount that they're financing has actually gone down year over year, as has the amount financed for subprime borrowers, the monthly payment for these same borrowers has actually gone up, as you can see here. While on the flip side, super prime borrowers have actually seen an increase in the amount of money they're financing for a car, but they've seen their monthly payment actually decrease. In fact, super prime borrowers are on average financing about $5 to $6 grand more than deep subprime borrowers, and yet super prime borrowers are paying $2 less per month on their monthly loan payment. It really does go to show how important credit score is and how this can drastically affect the affordability of a car and the monthly payments that you have for your vehicle. But enough of new cars, let's head over to used cars, and then we'll head into the delinquency step. You can see here that the majority of used car buyers are buying their used cars from franchise dealerships. And unlike with new vehicles where captive financing reigns supreme, with used vehicles, credit unions are the clear winner here, making up 27.63% of the total market share for used car loans, followed by banks right behind them. What's really interesting is that captive financing makes up by far the least amount of market share for lender type, sitting at only about 8.5%. You can see a breakdown of borrower type here, with subprime and super prime borrowers increasing a bit over the last year, And you can see a breakdown of how used cars are trending over the last year. The average used amount financed has gone down by more than $1,000 over the last year, which is great. But despite this over $1,000 increase, the average monthly car payment has only gone down by $11 per month. And that is because of the fact that interest rates over the last year have increased, going from 11.47% in Q2 of 2023 to 12.01% in Q2 of 2024. And while the average used loan term has technically gone up, it hasn't gone up by much. And this is not surprising at all, and this is something that we've talked about on my channel many times. The reality is used car prices are going down, but many car buyers aren't feeling this decrease because of the fact that interest rates are astronomical. I mean, 12% for the average interest rate on a used car, that is insane, and that is keeping these monthly car payments very high. But hopefully we will have a turning point soon whenever the Fed lowers interest rates, but more on that later. And you can see this broken down even further here. You can see that the average used loan amount has decreased by 3.91%, or $1,068. But quarter over quarter, this has actually increased by 0.73% or $191. And similar to the trend that we saw with new cars, you can see that even though super prime borrowers are buying cars that are nearly $10,000 more expensive than deep subprime borrowers are still paying $10 more per month for their car compared to super prime borrowers. You can see here that deep subprime borrowers are paying on average $532 per month, which is $7 more than this time last year, while super prime borrowers, even though they're buying a more expensive vehicle, are paying $522 per month, which is a $10 decline. At the same time, the amount that deep subprime borrowers are financing has increased year over year by $284, while the amount that super prime borrowers are financing has decreased by $1,023. But pretty much across the board, with the exception of deep subprime borrowers, we are seeing a decrease in the amount of money that people are needing to finance for their used cars. And we are seeing, again, with the exception of deep subprime borrowers, that the monthly payment on used cars is declining, which is great news. But this is whenever we get into some of the more concerning data of this market report, and we really see the effects of inflated car prices that we've had over the last couple of years and how this is impacting today's market in 2024. First of all, the outstanding loan balances for cars has increased by 2% year over year. Not only that, but 30-day delinquency balances are up, as are 60-day delinquency balances. But what I really want to focus on here with these delinquency stats is the fact that these statistics are getting close, or in some cases even surpassing 2018 levels. You can see here that the percentage of auto loans and leases that are 30 days past due are just 3 basis points behind what we saw in 2018 pre-pandemic. And when it comes to 60-day past due, we have surpassed pre-pandemic levels. When it comes to the percentage of auto loan balances past due, well, we've surpassed pre-pandemic levels for both 30 days and 60 days. And the thing that is incredibly important to point out here is that not only have the percentage of auto loans past due surpassed 2018 levels, but the overall balance of auto loans has also drastically surpassed 2018 levels, which is something that has been trending in the wrong direction for a number of years now. And so the amount of money and loans and balances that are past due with car loans is at the highest level that we've probably ever seen. And that definitely isn't a good thing, given the fact that there are some red flags that are popping up in regard to the overall economy and where the economy is trending short and long term. And as we've seen in many of the videos that I've shown in the past, independent dealerships are disproportionately affected compared to franchise dealerships, which oftentimes comes down to the fact of the type of buyer that are going to these independent dealerships versus the ones going to franchise dealerships. Independent dealerships are disproportionately going after buyers with poor credit scores. These buyers are paying a higher price for the car, typically a terrible interest rate, and they also typically fall victim to predatory lending practices more frequently than those same types of borrowers at franchise dealerships. So the fact that independent dealerships are handing out more delinquencies than franchise dealerships, it makes total sense. The only silver lining here is the fact that the Federal Reserve does look as though they're going to be lowering interest rates just here in a couple of weeks. And this will absolutely impact the affordability of cars. But what this isn't going to have a huge effect on are people that have already taken out loans for their cars. Of course, they could refinance, but the majority probably won't. And so these people who took out these large, expensive car loans that are now falling behind on them, well, chances are interest rates going down really isn't going to save them much. And I hate to say it, but I think that this delinquency situation is going to get far worse before it gets better. And that isn't good. But like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it. So make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell. And I will see you guys in the next video.